how do I incorporate volatility into my trading, and how can you incorporate volatility into your trading? Well, I think that the easiest things to do are to understand and to use a concept that we call the average daily range. And the second thing, which really goes beyond the scope of this webinar, is completely different topic, but something that I do as a trader, is to chart my markets using range bars. So what is the average daily range? And I will use the average daily range and the acronym ADR interchangeably during the webinar. But the average daily range is simply the difference between the daily high and daily low averaged over the last 7 days. So basically, it's just the moving average of that difference over a 7-day period. So what do we do with the average daily range? Well, there are a few benefits and a few things that I get out of using the average daily range and understanding it. The first is to assess recent market volatility and to understand your trading environment. The second benefit here is to prepare for potential market moves. I use pivot points. I love pivot points, and as a day trader, I find that they are effective. And then lastly here, benefits of the average daily range, I can take the average daily range and I can use it to make decisions on my exits. And let's look at an example here. This is a chart. Okay. So based on, again, this is something I've programmed into my charting software. It's easy to calculate by hand, but you could probably, depending on the software that you're using, make it very easy to get these calculations and have it be programmed into the software that you're using. But we see here that the average daily range currently, let's take a step back. This is the Euro futures contract. As a trader, I trade futures, but the Euro contract is basically representing the Euro against the U.S. dollar in spot Forex. So it's going to give us the same type of movement. It's just traded through the CME, through an exchange, that really being the difference there. But we see here, top of my chart, that the average daily range based on the last 7 days is 175 ticks or pips. So based on this average daily range, 15%, it's calculated for me, is a 26 tick target, and my stop is 17 ticks. Let me just write this down just to make sure it's easy. I don't know how small that is, but with the average daily range at 175, we'll say pips to make it easy. I know that as a futures trader, you'll probably hear me say ticks and pips interchangeably throughout the webinar today. Bear with me, but we'll try and keep it pips since I know many of you are currency traders here. So based on the average daily range, if we're looking at 175 pip range, ADR, times 10%, that this would be 17.5. That's going to be my stop loss. 175 ADR times 15%, well, that's going to be, my software is rounded up for the target, it looks like, and down for the stop. But either way, that's fine. And we'll just say rounded to make sure if anyone does the math. I mean, really at this point, one tick or pip difference isn't going to really matter. But based on my calculations, I'm looking for a 26 pip profit, and I'm willing to risk 17 pips. Now, it's not less than 1-to-1, because 1-to-1 would be a 17 pip target, 17 pip stop loss. It's 1.5-to-1, and based on the type of movements that I'm looking for smaller trends in the market, and I'm looking to identify, this way I might get a couple of moves a day. Anyway, to make it easy for today's session, what I'm going to do is just to show entries and to kind of show you how the average daily range target stop works and how it might be valuable to you. I'm going to use MACD and just use a simple MACD system for entries, and I'm going to use the average daily range for my exits, right? So the rules are going to be go long when MACD is above the 0 line and above the signal line. When these conditions are met, we're going to have a green bar. I programmed this into my software, but again, you can just look at MACD to make that entry decision. So that's going to be our entry rule for a long entry. Our entry for a short entry is going to be when MACD is below the 0 line and below the signal line. Whenever those conditions are present, we will have a red bar. Now, black bars mean that there's a MACD crossover, but MACD in relation to the 0 line isn't right for those rules. So like here, MACD is below the 0 line, but it's not below the signal line. So when that happens, we have black bars. Just like here, MACD is above the signal line and the 0 line, and then MACD crosses back over, giving us black bars, and then when MACD gets above the signal line again, then we get green bars once again. So our entry rules will be based on those conditions, and whenever we get a green bar to go long, whenever we get a red bar to go short. Now, starting at the very beginning of the day, this was the first bar that completed for the session. It's green. So based on our MACD rules, we look at an entry at 36.80. And this is just to give an example of the average daily range target and stop loss. 36.80 would be an entry point. Because I'm using a 17-tick stop loss, my stop loss is going to be, even lower, my apologies, 36.63. And I'm using a 26-tick profit target. So my profit target is up here at 37.06. So we see, just using the average daily range for our target and our exits, we see that our stop loss is appropriate for this market. We get the move on up to our target, and that would be a reason to get out of a trade. Now, when our conditions are met for a downtrend again, I'm using a 20 or a 12-tick range bar. Sorry, again, I'm using this as an example. A 12-tick range bar is what I use for my trading. But my goal in the webinar is to discuss exits based on the average daily range, not so much entries. Otherwise, we could do a whole workshop that's 4 hours long on everything here. But based on our rules, we have a red bar. So MACD is bearish based on the rules that we talked about. 36.65, we would be short. Now, our target, 26 ticks lower, is down here at 36.39. Now, our stop loss, 17 ticks. So our stop loss this time is actually triggered. Pretty easy to see that, but let's see exactly where we'd be. Okay. So when the market was bullish based on MACD, using the average daily range as an exit, we take 26 ticks or pips. Here with a short signal, we get stopped out for a 17 pip stop loss. So on the two trades, we're still up for those two trades. We're up 9 pips. Now we get black bars. So black bars tells me that there's a crossover, and now we can look for a new entry if we do have our entry signals. This bar completes red. We're looking at 36.60 as an entry point. Our 16 or 17 tick stop loss is up here, 36.87. Our 26 tick target is down here at 36.34. So just barely squeaked this one out. We got down to 36.33, one tick through our profit target. As a futures trader, we know that based on this print, that we would definitely have been filled on our exit had we been filled at 36.60 with our entry. So by using 15% of the average daily range as my target, 10% as the stop loss, and using rules for a trend following entry system, the average daily range gives us targets and stops that are appropriate for the market conditions, and we could capture some of these smaller moves, and our risk is going to be appropriate for those conditions.